Good morning, good evening, or wherever it is, wherever you are. Rob McGregor here with the end of September update on OnTrack, your monthly update on what's happening in the world and why it matters or why it doesn't. Apologies, we're a little late on this one. Back in the country, lots of work catching up and had a few technology challenges this month, but let's get into it. Firstly, our general advice warning. This video is designed for clients of McGregor Wealth Management who are getting ongoing advice. It's to supplement that advice, and it may be of interest to others, but it's specifically designed for our clients. So what we're going to cover today, we're going to cover some of the economic news and happenings. We're going to put it into context. I'm going to update you on the key markets that our investments are in and put that all into perspective. So some of the news highlights in Australia, we've got rates going lower. The RBA cash rate to 0.75%. The market has at about 70% probability that it's going to go lower again. And we've got 10-year government bond rates at 1.06%. So that means if you invested your money in a 10-year government bond, you'd get back just 1% a year on that investment. So as low as anyone who's alive has ever seen it in their lifetime. We've got Sydney and Melbourne housing recovering based on the latest monthly numbers. They look like they're coming off the bottom. That's probably partially helped by the low interest rates, but also just strong cities that Sydney and Melbourne are. This housing downturn was always going to be temporary. I think it'll go sideways for a long time, and I'll talk more about that when we get to that. Consumer and business confidence is below average, which is interesting, and that's stopping people from spending, which is perpetuating this lower growth environment that we're in. Internationally, the US has got some good signs. It's got pretty strong retail growth. It's got pretty good wage growth, and they're good signs of an economy growing. We're unlikely to get a recession in the US. No one can ever say for sure, but growth is closer to 2%. They'd rather see it at 3%, but it's better than the 0%, which is characteristic of Europe, Japan, and some of the other developed world. We've seen some progress on the US-China trade war, but this is really just the first skirmish of probably a 30-year battle between the US and China. The US has been top dog in the world for near on 100 years, and we're seeing that progressively changing. China will have the biggest economy in the world by about the 2030s. It's got a lot more people, so that standard of living per person is still a lot lower than the US, but we're looking at the start of a multi-decade battle between those two superpowers. There's lots of geopolitical stuff happening around the world at the moment, skirmishes. We've got the Hong Kong protests and unrest. We've got trade disputes between Japan and Korea, and we've got Middle East unrest. Now, it's funny as I say that, I could have been saying these things 20 years ago, 30 years ago. There's always unrest in the world, and I don't mean to diminish each of those circumstances, but ultimately life goes on for the rest of the world, and some of those things are horrible, and once again I'm not meant to diminish them, but to put it into perspective for our investments and the world. We're also faced with more intense media spotlight than ever. The media is competing for our attention, so they love to focus the camera on whatever's going wrong in the world relentlessly because they know that gets our attention. So the continuing theme, we're in a world of low economic growth, low inflation, low interest rates. Share markets are climbing that wall of worry. They're giving good but lower returns, and I'll talk about that in a moment. So I just want to revisit the 4 foundations to a great investment strategy that we're always working on. One is investments are part of a plan, so you know why you've got the investments. We know the purpose of the investments. We have a deep understanding of history and market cycles in particular, so we can learn from that historical cycles. They never appear the same way, but we can learn patterns and put things into perspective. The biggest risk to most of us is making mistakes that are emotionally or behaviorally driven. That's the panicking when markets are down, it's doubling up when markets are up, and all those types of things. And ultimately, when we handle those things, we can just get on with smart investing, diversification, regular rebalancing, getting the right risk profile, and all those things that we do that are fundamental to how we manage money, but can only work if we've got the others right. So that market context and our framework, and you'll see there our friend the index chart, which shows that historically shares wobble up that wall of worry. They have an occasional boom, which is very much nearly always followed by a bust, which doesn't take it back too far if you go back a few years, but most of the time, 80% plus of the time, we're in that wall of worry, and we're quite clearly in that wall of worry zone at the moment. We're worried all the time, and don't forget that characteristics of a boom is when people stop worrying, and we're certainly not seeing that at the moment. Quick reminder on how most investors mess it up, and the media, I believe, is the biggest one. And as I said, that constant focus on whatever's wrong in the world. The media is not the right source. And then the others there, and I'm not going to run through them today, but always there is a reminder that if we don't get this stuff right, it's very easy for us to do what that top chart shows and get less than half the returns that are out there because of our behavioral mistakes. So my main focus before I get into market returns this month is looking at the conflicting forces that are happening on the market. So we've got a chart here that goes back around 5 years of the All Ordinaries in Australia, and we've seen it wobble up, wobble down, go through occasional sprints, go through occasional worries. And the headwinds, the things that are getting in the way of it keeping going, one is the fact that we've just got low world growth. So that limits companies' profit growth, so we can't grow too much because we're just not in that environment. We've got low inflation, so that means prices go up slower, so that means it's harder for companies to put up prices more than inflation, so they'll ultimately only have slower profit growth. We've got high debt levels around the world. In some countries that's government debt, in some countries that's consumer debt. So the US, for instance, has high government debt. Australia has very high consumer debt. One of the factors around that is with low interest rates, and that's one of the tailwinds, the cost to service that debt is no higher than it's ever been. So the cost of that high debt is not impacting the world at the moment, but it's the fear of what might happen if and when interest rates go up that causes that to be an issue. We've had the trade war, or should I say trade wars, as you get certain styles of leaders that they go into protectionist mode, and that doesn't help world growth. And it's a self-interested sort of focus. And we've got geopolitical events. Now, once again, some of those things will always be around, particularly the geopolitical events and particularly the skirmishes between countries. That's been happening for literally thousands of years and will continue to happen. But let's have a look at some of the tailwinds. They're the things that help companies grow, which ultimately helps share markets grow. Low interest rates are good for companies. It means that the debt that they have, they're paying less interest. It means they can borrow more affordably to invest. So that's a good thing for share markets. The other factor with share markets is when people are comparing investments with low interest rates, they're more likely to invest in the share market, and the more people that go into the share market, the higher the price goes up as well. We've got quantitative easing or money printing happening in many parts of the world. And our own RBA has said they wouldn't rule that out, although we haven't been doing that. Money printing is just where they issue more money. Ultimately, that finds its way into the economy, and that will eventually help the economy get into a higher growth pattern. Eventually is the big word, though. We've got some growth, which is good. So that means good companies can still make a profit, and they are still making a profit. Keep in mind that when you hear about a slowdown in growth, the world is still growing. And some of you have heard me talk about the developed nations are like a doctor that's earning, say, $300,000, and if for a few years it doesn't grow, they're still earning good money. They're still spending money. And when we talk about growth, that's on the world economy, the GDP, which is the income of the world. So it's not falling away. There's not no income. It's still being spent. So life goes on and good companies make money. There's an acronym there called TINA, and that is there is no alternative. In other words, you've got to take some risk. You've got to put your money in either the share market or the property market because cash rates are dropping fast. And I suspect term deposit rates will be pretty close to 1% within the next 6 months. They're about 1.8 at the moment. Company profitability is okay. There's lots of companies making good profits. I think 80% of the ASX is profitable. Dividend yields are sticky. Dividend yields on Australian shares still about 4.5%. Before the franking credits, which pushes it up to about 6%. That hasn't come down, even though interest rates have come down. Now, two ways that would come down. One is if people were willing to pay more for the share market. So if we decided all of a sudden that 3% was a fair yield from the share market and companies still had the same profitability, the share market would be double what it's worth today because we've currently got a 6% yield. Now, I'm not suggesting that's going to happen, but we've got just as much risk on the upside at the moment by that sort of trend happening as we do on the downside. We've got more and more of the world, China, India, even Africa, coming into capitalism, which increases the markets and the potential for companies. Valuations are reasonable, they're not stretched, and we don't have a boom, which makes the chances of a major correction, that is one more than 20%, very unlikely and almost unprecedented. So those conflicting forces are probably going to keep us in that wall of worry. We've seen returns hover in that 6 to 8% range for most people in sort of growth to balance type investments, and I suspect that's going to continue for a while. That's not such a bad thing. Aussie share market up 1.9% for the month. We're sitting on about 12% for the year. That's coming off the back of a downturn in September, October, November last year. So at the moment, the 12-month returns are looking great, and they're pretty good. But if you can see in that chart, if you go back a bit further, the market was higher. 10-year returns, I mean, that long-term return there, which goes back to 99, is almost that textbook picture of that boom-bust wall of worry. US shares up for the month, steady for the year at about 10%. Part of that is due to the US dollar gaining against the Aussie dollar. And in that 5-year chart down the bottom there, you can see that blue line shows that 27% out of the 89% return over the last 5 years in US shares has come from a declining Aussie dollar. One of the reasons that the Reserve Bank is dropping interest rates, we suspect, is because they don't want the dollar to go up. If they leave our interest rates too high, that brings in money from overseas and that pushes up the Aussie dollar, which makes our industries less competitive. And of course, the only downside for us, all of us who travel, is our dollar's still not buying as much in Europe and the US. But I suspect that's a fair chunk of why the Reserve Bank is keeping cash rates low, is because they don't want the dollar to go up. US small cap shares, a key part of growth in the long run, has had a flat year. It's actually gone down, which it needed because it had had a pretty good run, and we were out of those for a while. We're happily back in there. It is the engine of the growth of the world, US small caps. And US small caps, most of those companies would fit in the ASX 200, so they're not tiny companies. They're solid companies that are emerging. A key part of portfolios and one that's contributed to good growth over time, but very much in that fair zone there now. Global leaders, we think they're in the fair to expensive range, which is where we believe US Aussie shares are as well. Now, no one can say for certain what's fair value and what's not. We have a model that helps us understand that, but the model's dependent on interest rates. So if we factored in the current interest rates for the next 20 years, shares are dirt cheap. But obviously no one believes we're likely to have those lower interest rates for the next 20 years. We're likely to have them for the next 3 to 5, but it could break out sooner than that. All this activity from government's low interest rates, it's a bit like throwing fuel onto a fire. Eventually it'll catch fire, and at that point the economy may take off. Can't see it at the moment. No one can see it. It's always scary when people agree on these things, but eventually it'll come out. Eventually we will have higher interest rates. And the governments will have to clean up their act debt-wise. That'll come with taxes and everything else. And as always, the market cycles, and share markets survive those things. Emerging share markets have been the most impacted. They've got lower returns over the last little while from the US-China trade wars, but we saw that jump on the announcements of some sort of deals between the US and China last month, which prompted emerging market shares to rise a bit in relief. We still think they're cheap, and once again, an important part of portfolios for the long run. Look at gold, 1 year, 33% return. So gold, which is in your portfolios as an insurance value, because when things are uncertain in the world, people gravitate towards gold. Gold also acts as an effective currency. So as countries around the world are printing money and effectively debasing their currencies, hard assets like gold will probably continue to go up. We would never ever suggest having too much in gold. It doesn't produce income, so you can't live off that. But as an insurance policy, it's a good part of the portfolio, and it certainly helped our performance over the last little while. So performance of the portfolios to the end of September, sitting above those long-term targets. If you look at the year column, in the top half of the table, we've got the core funds. They're the funds that make up your core of your investments. And they're sitting, with inflation around 2% at the moment, they're sitting well above those targets for 1, 3, and 5 years. The care is where we add the active portfolios and enhanced, and that pushes up the returns a little higher. because for most of our retired clients, we'll also be carrying the R, which is the reserves. That'll bring the return back a little bit, but does provide us that very important buffer of being able to pull money out of low volatility investments to pay for living expenses. So the portfolios are actually performing in the top 10 to 20% of their peer group, and as good quality low cost portfolios, we're very pleased to see that, because it means we can plan for you guys and with a reasonable amount of confidence that you're on track for your goals. So portfolios doing well. Property markets, and as I said, recoveries in Sydney and Melbourne. You can see my scribble there around the month changes. Melbourne and Sydney prices are up. I do expect them to stay sort of steady for a period of time. Generally, after any correction, markets will stay steady, but it really depends on population growth and continued population growth in Sydney and Melbourne. Melbourne in particular has extremely strong population growth, and these forces will cause some areas. Markets are not just one city. For instance, Sydney has multiple submarkets, Melbourne has some submarkets. They do tend to move together, but there will be stories there. So for those looking for opportunity, there are opportunities all around Australia. We tend to think Perth and Brisbane are probably better for immediate returns in the next 5 years, but certainly Sydney and Melbourne are rock solid. And while we've got low interest rates and population growth, that puts a floor on where property prices are likely. If we did stop population growth and if we had high interest rates, that may make that a very different story, but no sign of that. The property clock from Heron Todd White is interesting. I don't always agree with their stuff, and that's fine. That's a market where people have different opinions, but they've actually pushed Sydney all the way around to the start of recovery, and Melbourne as well, including Newcastle and areas around Melbourne, Sydney. They've got Brisbane there. So in theory, according to them, there's good opportunities. We're past that peak of the market and that decline in those cities. We tend to like places that have been down in the doldrums for it longer. I saw a very good report this month on Brisbane that shows inevitably as Brisbane's population growth, it catches up to about 70 to 80% of Sydney prices. Population growth in Brisbane and southeast Queensland has been slower over the last few years. As economic times boom, people do move to Queensland, and eventually that pushes those prices up. So interesting watching these observations. Units, much the same, some slight differences, but really all the same. So let's wrap it up and put that into perspective and what the current conditions mean. And as I will nearly always say, it's steady as she goes. When you've got a good plan and when you've got a good investment strategy, there's no need to mess with it, as most people, when they do that, mess it up. So steady as she goes. Stick with the plan. It's not a bad time to be buying or selling. There's, as always, maybe better times. So if you've got extra capital needs coming up, or you might have extra money coming in, we can talk about what might be a good time to buy that. And if the market gets a little more expensive, we'll tend to average in new money, or wait to put in new money, but certainly not selling or taking anything out. The markets are well within their normal bounds. As always, for people that need to top up their reserves, it's a good time, and it's a great time for our clients that are still building wealth through dollar cost averaging. Nothing better than volatility to enhance their entry and their building up of their portfolios. So continue to review, as we'll always do. I look forward to seeing you at your next review, talking to you when and if needed. And as always, contact myself or the team if you've got any doubts or things that need looking after, and in particular, any changes in your circumstances. Rob McGregor here, signing off, and look forward to talking to you next month. And have a great week and enjoy spring and as we go into summer.